Hi dear traders, last week was marked by speculation about the possibility of a higher rate hike by the Fed. More analysts expect the FOMC to lift the rate by 50 instead of 25 basis points at its next meeting. Besides, it turned out that inflation in the US declined at a lower than expected pace in January. The producer price index also reveals that the situation is not going to improve anytime soon. Let's discuss in our review how this background has affected the foreign exchange and commodities market. The US dollar was gaining ground as expectations of a tougher Fed policy increased. The US dollar index, which measures its strength against the basket of 6 major currencies, hit a 6-week high last week to settle above 104. By the end of the week, traders decided to take profit on their long positions on the dollar. This resulted in a pullback in US dollar index. Meanwhile, the euro managed to close last week in positive territory. The euro-dollar pair gained 0.17% and was trading at the level of 1.07. The European Central Bank, just like its American counterpart, is ready to lift the rate by 50 basis points despite the threat of recession and slowing inflation in the region. At the moment, the ECB rate is holding at its highest level since late 2008. As for the British pound, it closed last week at the opening level of 1.20. Inflation in the UK came in lower than forecasts predicted. That's why the Bank of England may soon want to ease its monetary tightening. The interest rate has already hit the level of 4% and expected to be raised 2 more times by June to reach 4.5%. The yen was the most sensitive currency last week. The dollar-yen pair returned to the level where it was last seen almost 2 months ago, that is to 135 yen per dollar. Markets also evaluate the nomination of Katsuo Ueda as the new head of the Bank of Japan. If approved, Mr. Ueda will become the first academic economist to run the bank in post-war Japan. He already said that the current ultra-loose monetary policy was appropriate and should be continued, so the Bank of Japan keeps its interest rates low and preserves the yield policy. According to the current governor of the bank, the inflation target of 2% can only be achieved through increased wages. Last week, gold was also testing lows amid a stronger US dollar. The price of the precious metal dropped to $1,830 per troy ounce, its lowest level in 6 weeks. Gold traders were especially sensitive to the comments by the Fed officials. Thus, Cleveland Fed President Loretta Mester said she saw a compelling economic case for a 50 basis point increase. Her colleague from St. Louis held the same view. So, such hawkish rhetoric pushed gold down by 1.12%. In the meantime, oil posted losses last week as fears over restricted supply were mounting amid a global recession. The possibility of the Fed raising its rate by another 50 basis points only worsened the outlook. In addition, the US government declared it was going to release 26 million barrels of oil from its strategic oil reserves. However, the OPEC forecast and the International Energy Agency outlook for oil demand improved for 2023 as China is expected to ramp up energy consumption after reopening its economy. These are the trends of the last trading week, and now a new week and new portion of macro events are ahead. Do not miss our daily news reports and the weekly review, which is due tomorrow. Stay tuned and see you soon.